August 15, 1971, a Sunday night. Most Americans are sitting in their living rooms, some watching television, some getting ready for the work week ahead. And then Richard Nixon comes on the screen and says something that most people in that room didn't fully understand, something that economists at the time didn't fully understand, something that the global financial community would spend the next decade paying for in ways nobody anticipated. He looked into that camera, calm as a man announcing a weather forecast, and told the world that the United States dollar would no longer be convertible to gold. That was it. One sentence, one decision, and in that moment, a monetary system that had anchored global trade and economics and stability for 27 years was finished. Gone. Not reformed, not adjusted. Finished. I was 17 years old in 1971. I wasn't yet the investor I became. I wasn't thinking about monetary systems or reserve currencies or the price of gold. I was a teenager, but I have spent the last 50 years studying what happened after that night. Because what happened after that night is the single most important financial case study in modern history. And I'll tell you why I'm bringing it up right now, today, in 2026. Because when I look at what is happening in this country, in these markets, in this global monetary system, I keep seeing 1971, not as history, as a pattern, as a warning, as something that is not behind us, as something that is happening again right now in real time, and almost nobody is saying it plainly. So that's what I'm going to do today. Say it plainly. Let me take you back to 1944 first, because you cannot understand 1971 without understanding what it destroyed. In the summer of 1944, as World War II was still grinding toward its conclusion, representatives from 44 Allied nations gathered in a small town in New Hampshire called Bretton Woods. The world economy was in ruins. The 1930s had been a catastrophe of competitive currency devaluations, trade barriers, protectionism, economic nationalism. And the consensus among the people in that room was that those policies had not just caused economic suffering, they had helped cause the war itself. Countries that couldn't trade peacefully had gone to war. So they built a system to make peaceful trade the path of least resistance. The system they built was elegant in its simplicity. Every currency in the world would be pegged to the US dollar, and the US dollar would be pegged to gold at a 35 an ounce. Any foreign government that accumulated dollars could walk up to the US Treasury and exchange them for gold at that fixed rate. It was a promise, a contractual obligation, and it worked beautifully for the first 15 years. Europe rebuilt. Japan rebuilt. Global trade expanded. The post-war prosperity that Americans look back on as the golden era, the 1950s boom, the growing middle class, the expanding manufacturing economy, all of it happened inside this system. The dollar was the anchor, and the anchor held. But here is where it gets interesting. And by interesting, I mean instructive. Because the system began to crack not because of an external enemy, not because of a war or a natural disaster, but because of the internal choices the United States government made. In the 1960s, President Johnson decided to fight two wars simultaneously, the Vietnam War abroad and the war on poverty at home. Both were expensive. Both required money the government didn't entirely have. So they borrowed, and they spent. And the Federal Reserve, under pressure from the White House, kept money loose to keep the economy humming. Dollars flowed out of the United States in enormous quantities to fund overseas military commitments, to pay for imported goods, to support allies, and those dollars accumulated in foreign central banks. Now, here is the problem. The U.S. had promised those central banks that they could exchange their dollars for gold at 35 an ounce. But the number of dollars in circulation was growing far faster than the gold in Fort Knox. By the late 1960s, The United States simply did not have enough gold to honor the promise if everyone tried to collect at once. France figured this out first. French President Charles de Gaulle, who had always resented what he called America's exorbitant privilege, the ability to print the world's reserve currency and live beyond its means, began sending ships to New York to collect French gold deposits. Literally, ships. In 1971, Britain requested to convert $3 billion in dollar holdings to gold. Switzerland left the Bretton Woods system. West Germany left. The runs were accelerating. The moment of reckoning had arrived. And so Nixon went on television on that Sunday night in August and did what governments throughout history have done when they've spent too much, borrowed too much, and promised too much. He changed the rules. He told the world the promise was suspended. Temporarily, he said. The gold window was closed temporarily, he said. It was never reopened, not once. Not for a day. The temporary suspension became permanent within 2 years, and by 1973, the entire Bretton Woods system of fixed exchange rates had collapsed. The world moved to floating currencies, and the dollar, untethered from gold, began to do what fiat currencies always do when the discipline of a hard anchor is removed. It drifted. Then it fell. Then it fell harder. What followed over the rest of the 1970s is one of the most painful economic decades in American history, and I want you to really understand what it felt like to live through it, because the textbooks make it sound clean. Stagflation, they say. Inflation combined with slow growth. It sounds almost technical. It was not technical. It was a grinding, demoralizing decade-long assault on the living standards of ordinary Americans. In 1971, the year Nixon closed the gold window, annual inflation was running at 5.84%. The unemployment rate was 6.1%. By 1974, inflation had surged above 11%. By 1980, it peaked near 14.5%. Unemployment climbed above 7.5%. Both numbers were rising simultaneously. People were losing jobs and watching the purchasing power of whatever money they still had erode month after month, year after year. Gas lines stretched around city blocks. The OPEC embargo of 1973 quadrupled oil prices almost overnight, and the dollar's devaluation after 1971 was part of what triggered it, because oil producers priced their product in dollars, and when the dollar fell, their real income fell with it. So they raised the price in dollars to compensate. This is the chain reaction that people miss. Currency devaluation doesn't just affect currency traders. It transmits through commodities, through import prices, through energy, through food, through everything that has to travel a supply chain to reach you. A weak dollar is not just a financial statistic. It is a tax. It is a hidden, regressive tax that nobody voted for and nobody formally announced, but that shows up every month in every grocery bill, every utility statement, every visit to the gas pump. The stock market lost nearly half its value between 1973 and 1974. Housing became unaffordable as mortgage rates climbed toward 18% by 1981. Savings accounts were paying positive nominal interest, but deeply negative real interest, meaning people were getting poorer while being told their money was earning income. The Federal Reserve, under Chairman Arthur Burns, kept making the same mistake over and over, cutting rates to stimulate the economy, letting inflation rip, then trying to tighten, then losing nerve and cutting again. It was a decade of policy paralysis dressed up as policy action. It took Paul Volcker walking into the Federal Reserve in 1979 and doing something almost unimaginably brutal, raising interest rates to 20%, deliberately causing a deep recession, accepting unemployment above 10%, to finally break the inflationary spiral. And even that took 3 years to fully work. 3 years of deliberately inflicted economic pain to undo the consequences of 8 years of monetary indiscipline, that started on that Sunday night in August 1971. Now, here is why I am telling you all of this. I want you to look at where we are in 2026 and tell me how many of those conditions are not present right now. Because I have gone through the list carefully as I do everything, and the similarities are not superficial, they are structural. Start with the spending. In the 1960s and early 1970s, the United States was fighting two expensive commitments simultaneously and financing them through a combination of borrowing and monetary expansion. Today, the U.S. national debt has crossed $36 trillion. The federal government is spending roughly $2 trillion more per year than it collects in taxes. We are not in a war in the traditional sense, but we are maintaining a global military presence. We have made enormous commitments to social programs that grow every year, and we added trillions in emergency spending during COVID that was never unwound. The fiscal situation today is not as bad as 1971 in absolute terms. It is worse. The debt-to-GDP ratio today dwarfs anything Nixon was dealing with. Now look at what the dollar has been doing. The dollar fell roughly 10% against major currencies over the past year. The dollar's share of global foreign exchange reserves has declined from about 72% in the early 2000s to roughly 57% today. In 1971, the pressure on the dollar came from foreign central banks demanding gold. Today, the pressure comes from foreign central banks quietly diversifying out of dollars, buying euros, buying yuan, buying gold. Not in a panic, but in a deliberate, sustained, directional shift that has been going on for 20 years and is accelerating. And the tariffs, the parallel here is striking enough that I want to say it carefully. In 1971, Nixon imposed a 10% surcharge on all imports as part of his economic package. The stated goal was to protect American industry and reduce the trade deficit. Sound familiar? And what happened? In the short term, the markets rallied. In the medium term, inflation accelerated. In the long term, the disruption to global trade undermined the very dollar dominance it was meant to protect. Because if you reduce global trade, you reduce global dollar circulation. And if you reduce global dollar circulation, you reduce demand for dollar reserves. And if you reduce demand for dollar reserves, the dollar weakens. It is the same chain, moving in the same direction. And then there is gold. This is where the market is speaking loudest, and I want you to listen to it. In 1971, when Nixon closed the gold window, gold was fixed at $35 an ounce. Within 2 years, it had risen to $90. By 1974, it was above $180. By 1980, gold had reached $850 an ounce, a 24-fold increase from the 1971 fixed price in less than a decade. Why? Because gold is not an investment in the traditional sense. Gold does not pay dividends. Gold does not generate earnings. Gold does not compound. What gold does is hold its value when the currency it is priced in is losing trust. When the world loses faith in the dollar, the price of gold in dollars goes up. That is not alchemy. That is arithmetic. Today, gold is above $3,000 an ounce. Central banks around the world purchased more gold in 2024 than at any point since the 1960s. The share of gold in emerging market foreign exchange reserves has more than doubled in the last decade. J.P. Morgan is forecasting gold approaching $4,000 by mid-2026. When you see that kind of institutional accumulation at these prices, the market is not telling you gold is cheap. The market is telling you the dollar is increasingly expensive to trust. That is the signal. That is the same signal the market was sending in 1971, and almost nobody was reading it clearly. I want to address something that I think gets badly misunderstood when people talk about this period. 1971 was not, on the day it happened, obviously a catastrophe. In fact, the short-term reaction was almost positive. The stock market rallied initially. Nixon's approval ratings went up. People felt like someone was finally taking charge. The phrase, Nixon rally, was used to describe the brief period of market optimism that followed the announcement. The catastrophe came later. Slowly, then all at once. The inflation didn't fully express itself until 1974. The gold surge didn't hit its full force until 1979. The economic pain peaked in 1980 and 1981, a full decade after the decision that set it in motion. This is the part that trips people up every time. Monetary consequences are delayed. Policy mistakes in the monetary system do not produce immediate pain. They produce a few years of apparent stability, sometimes even apparent prosperity, while the pressure builds underground. And then, when the release finally comes, it looks sudden. It looks like a crisis that came out of nowhere. It never comes out of nowhere. It always came from somewhere. It came from choices that were made years earlier, and the bill just arrived. I want to be specific about what I think comes next, because I don't believe in being vague when I can be precise. The first thing I expect is continued dollar weakness, not collapse. I want to be careful about that word, because collapse implies a speed and finality that I don't think is the right frame. What I expect is a multi-year depreciation, punctuated by brief rallies when global risk flares and people reflexively buy dollars the way they always have. But each of those rallies will be a lower high, and each subsequent sell-off will take the dollar to a lower low. That is the pattern of a structural decline, and it is already in progress. The second thing I expect is a return of inflationary pressure that the Federal Reserve will struggle to contain without causing serious economic damage. The Fed today is in a position extraordinarily similar to Arthur Burns in 1970. They have already cut rates into an environment where inflation is still running above their target. The PCE inflation reading at the end of 2025 was 2.9%, above the 2% target. The Fed is under political pressure. The economy is showing signs of softness, and the instinct every time is to ease, to cut, to stimulate, to choose the pain of inflation over the pain of recession, because inflation is diffuse and recession is visible. Burns made that choice repeatedly. It ended with 14.5% inflation and Paul Volcker. The third thing I watch closely is the bond market, because this is where the real danger is stored. Japan holds over 1.1 trillion in U.S. treasuries. China holds 682 billion, down from 1.3 trillion in 2013. Europe collectively holds trillions more. These are not passive investors. These are nations making active decisions about where to hold their reserves. And the trend is clear, not a stampede for the exits, but a steady, deliberate reduction in the proportion of dollar assets. As that reduction continues, the U.S. government faces higher borrowing costs on a 36 trillion debt load. Higher borrowing costs mean bigger deficits. Bigger deficits mean more treasury issuance. More treasury issuance with weakening foreign demand means yields go higher still. This is a feedback loop. And once it gets moving in the wrong direction, stopping it requires either enormous fiscal adjustment or an inflationary episode that erodes the real value of the debt. Neither option is painless. Now let me tell you what I would do. And I want to be clear that this is what I am actually doing, not what I'm telling you to do. Your situation is not my situation, but you deserve to know where I actually stand. I am short the US dollar. I have said this publicly. The dollar is at the top of its historic purchasing power range. Foreigners are overloaded with dollar exposure, and the structural pressures I've described are real. That is not a political statement. That is an investment thesis, and I hold it with conviction. I hold gold, not as my largest position. I'm not a gold bug. I don't think gold is the answer to everything. And I have watched gold traders lose enormous amounts of money making it their only trade. but as an allocation within a broader portfolio. Gold is doing what gold is supposed to do. It is rising when dollar confidence is declining, and that is the function it is supposed to serve. I own copper. The supply-demand dynamics are genuinely tight. Electrification, infrastructure build-out, AI data centers all require copper, and a weaker dollar means commodities priced globally in dollars go up in dollar terms. Copper is not a hedge. It is a real asset in a world where real assets outperform financial assets during inflationary transitions. I am focused heavily on international diversification, particularly in economies that benefit from a weaker dollar rather than getting hurt by it. Europe and Japan have suffered for years from strong dollar dynamics that compressed their corporate earnings when translated back. A sustained dollar decline reverses that dynamic. Their earnings go up in dollar terms. Their equity markets look more attractive in dollar terms. This is not a permanent position. It is a cyclical trade on a theme that I believe has years to run, and I remain very selective in U.S. equities. The companies I want are the ones with genuine pricing power, the ability to pass inflation to customers, and real asset backing. The ones I want to avoid are the ones that look like they're compounding earnings, but are actually just running at the treadmill of inflation. A business that grows 5% in nominal terms during 5% inflation is not growing. It is standing still in a hall of mirrors. Here is the one thing I want to leave you with, because I've given you a lot of history, a lot of parallels, a lot of data, and I know how this kind of analysis lands sometimes. It can feel overwhelming or abstract, or like something that happens to other people in other times. But I was 17 years old in 1971. My parents were ordinary people. My father was not a hedge fund manager. He did not know what Bretton Woods was. He did not understand what Nixon was talking about that Sunday night. He just knew that over the next 10 years, everything got harder. The money he'd saved bought less. The house felt further away. The future felt less certain than it had felt the decade before. That is what monetary disorder looks like from inside a regular life. Not a trading screen, a kitchen table, a paycheck that stretches a little less each month, a plan that requires a little more work to execute than it did a year ago. The difference between 1971 and today is that you have information my father didn't have. You can see the data. You can track what central banks are doing. You can watch the gold price. You can notice when the dollar weakens and understand what it means. You can look at a 36 trillion debt load and a government that spends 2 trillion more than it takes in and understand that mathematics is not politics. Numbers don't have parties. They have consequences. What you do with that information is your decision. I am not here to make it for you. I am here to make sure you have it. Because in my experience, the people who get hurt worst in monetary transitions are not the ones who made the wrong bet. They are the ones who never knew there was a bet being made at all. The last time this happened was 1971. What comes next will shock you, but it doesn't have